Yo, what's up, everybody? My name is Chris Johnson, and welcome to the Stock Market's Gym course, webinar, whatever you want to call it. So let's get this party started. Or not. All right, so I'm going to tell you guys a quick story, man. The reason why I even made this, because a lot of people were bugging me on social media to make this stuff, and I had no desire to do it. But my mentor passed away, and it kind of made me realize, I met this dude when I was in middle school, and I was going through some stuff. Both my parents were locked up. I met him, and it kind of just like he did a lot of things for me that he didn't have to do, right? So he taught me things. He showed me a different way of life. I was coming from a bad neighborhood. I was running around just doing stupid stuff, man. I was young. I was dumb. And he took a lot of time. He invested a lot into me. So when he's gone, I want his memory to live on. So it kind of inspired me to make this course. All right. So what are stocks? Stocks are a piece of a company that signify ownership in the company, right? So you get access to this company's profits. You own a small part of the company when you own a share, right? So companies offer stocks to investors so they can raise money, they can raise capital, they can open new stores, they can do whatever they want to do or whatever they need to do to grow and expand. And as they grow and expand, so will your investment, right? So if you buy a share in a company, you're a minority owner, you own a very, very small, very, very, very small percentage of that company. So for instance, with Starbucks, if they issued 1,000 shares and you own one, you own 1,000th of Starbucks, right? All right. So, like I was saying, they offer stocks to raise capital. So, if a chain of restaurants out in Colorado that has 10 stores wants to expand, they're going to need more money to do that. They can do that by going public and letting the public invest in them. They can take that money and go open up more stores or, do whatever they need to do to grow. All right. So, actually, when a company does this and they have their IPO, their initial public offering, they're now considered a publicly traded company. They have to report their financials. There's a bunch of obligations that they now have when you're a public company. So it comes with responsibilities, but you also know that any company that's out there that you can invest in, you can go look up, all their earnings, see how much money they're making, so much debt they have, all this good stuff. All right. So why should you buy stock? So everybody tells you, oh yeah, by the way, the purpose of this course is for me to teach a 10-year-old. I believe 10-year-olds can buy stocks and sell them at a profit, right? So if you're like advanced, then just bear with me. But I believe I can teach a 10-year-old how to buy and sell stocks for profit. So why should you buy stocks? You give your money to some of the best companies in the entire world, right? Billion, trillion-dollar companies. They earn more money. The value of their company grows, so your money will grow as well. These companies hire the smartest, brightest, most innovative, creative people in the entire world. And they want to break into emerging markets. They want to launch new products. They want to take over. They want to take over the market. They want to do whatever they need to do to grow. And with your money and with a bunch of other people's money, they can do that. So as they take over, your investment can grow with them. So just think about this. Like, think about what you're doing when you're investing into a company, especially these large cap companies. When you give your money to Apple, or you give your money to McDonald's, or you give your money to Domino's Pizza or Microsoft or IBM, like these are the brightest people in the world running these companies. They're a lot smarter than I am and than most of us are. So, we give them our money and they grow it for us. They grow the value of their company and our investment grows. Right? Some of these companies even pay dividends. So you can hand them your money, they go earn revenue, they bring back the profit, they distribute that back to their investors. So then you can start receiving passive income just from, as a reward for investing into these companies. Some companies are actually known for being dividend paying companies. All right, so there's two main strategies when it comes to investing. And I'm going to use real estate in here as well because they kind of go hand in hand, but there's capital appreciation, right? So if you buy an asset, you buy something today and you think the value is going to go up in the future so you can sell it for a profit, then you're investing for capital appreciation. So if you're living in Oakland and they're bringing a new, I don't know, they're bringing a new company there, or they're bringing a new sports team or whatever, and you think it's going to raise the value of your house, you know, then 2, 3, 4 years later, you can sell it for more. Capital appreciation. Same thing when you invest money in the stock market. You invest in Apple today or Google today, and in the future, the value of the company is going to be worth more. The shares are going to be worth more. So you sell it for more, or you can just hold on to it for long term. So that's like the first part. The next part is cash flow. So in the real estate world, you own a property. Let's say you're buying a property specifically so you can collect rent. So if that's the case, then you might not care about that a new football team is going to come, or I don't know, this new emerging company is going to put their headquarters there. You might not care about that stuff. You might care about the cost of the property versus what you can get for rent, right? So you're just going to bank on the cash flow. So some people do both. Some people pick one or the other. So in the stock market, you can build a portfolio that pays you dividends regularly. You can set up your portfolio so you can get monthly dividends or quarterly dividends, or you can structure the companies that you invest in so you're always getting a dividend every single month from different companies that pay quarterly. So there's the two types of investment strategies. So I like to do both, you know, so yeah. All right, so there's trading and there's investing, and I want people to know the difference, and I want you to understand the difference because they're not the same. So in the real estate world, it's like flipping a house. Like you flipping a house, you invested your money, but that's not an investment. You still have to go do the work. You still have to, even if you're not going to do the work, you still have to maintain the project as it runs, and then you'll eventually sell it for more, right? You flipped your money. Same thing in the stock market. You can swing trade. You can put X amount of dollars in to buy X amount of shares or even options or futures, and then you're going to sell it at a future date, and then you're going to take that money out. So investing, it's more long-term. It's boring. It's not as exciting as, you know, as people try to make it seem. It's pretty boring, but the results are, they compound, right? So it's kind of crazy in a way, but just buying and holding companies is pretty much the best thing you can do, you know. So you can make money swing trading. I make money swing trading, but I take the money that I make swing trading and I buy more of my long-term holds. So I might buy Apple today, sell it next week, take the money that I just made, and then buy more shares of Apple that I plan on holding, or buy more shares of Facebook or Starbucks, whatever the case is, right? So you can do both. You don't have to pick one or the other. One requires your attention, right? So when you want to swing trade, you know, you got to watch the market. You can't just put your money up and then, you know, hope for the best. You have to have a strategy. You don't have to have a strategy when you're investing. But some people don't want to be traders in the market. They kind of just want to set it and forget it. So we're going to cover both styles of you know, what you can do in the market. All right, so we're going to look at some of the top companies, right? So check this out. There's Coca-Cola. We can do Nike. We can do Denny's. You do all the companies that, you know, we spend our money with every single day. So we spend our money with all these companies, right? But yeah, sometimes people choose not to invest in them. So that's kind of the crazy part, is that we know how these companies make money because we give them the money. But somehow, some way, we choose not to invest in these companies, right? So almost every company every brand that you buy from, almost every single one is a publicly traded company. And if they're not, their parent company is, right? Because everybody wants more money so they can keep expanding and taking over the market, right? So here's kind of like the beauty of investing, is that the stock market usually always goes up, right? So even if it goes down, it eventually will come up. So as long as the company is doing what it's supposed to do, or the fund is doing what it's supposed to do, because inflation is one part of it. You might buy a Coke can for 50 cents. Maybe you could buy a Coke can for 50 cents a few years ago. Then it slowly goes up, slowly goes up, slowly goes up. So they're making more money. The value of their company is going up. You have to attach your dollar to it. So in the same way with like your rent or like your rent, if you rent a house or you rent an apartment, like every single year, your rent goes up, right? So the company that owns your apartment or the corporation that owns your apartment or the owner that owns the actual house that you're renting, they're going to make more money every single year. Their taxes are going to go up. Their expenses are going to go up. Everything's going to go up. So it's in your best interest to attach your money to a rising economy, right? So even companies that emerge, like Zoom kind of came out of nowhere, or Netflix or Amazon, right? You don't really know which companies are going to take off, but eventually, you're getting a good idea who's taking over because we start to know about their products. We start to use their products. 10 years ago, we weren't watching Netflix. That was, maybe we were, but 15 years ago, we weren't watching Netflix and they just came and took over. Apple became a really, really, really big deal as soon as they released the iPhone. So Apple's been around for a while. They're a computer company, but as soon as they released the iPhone, they kind of just, I don't know, they just took over the world, right? So look at this on a long enough scale. Apple was trading for $1 over here, 96, $1.50, 2006. Like this was crazy. So when did you get your first iPhone? Just think about this. When did you get your first iPhone? Probably 2010 or 2011. Your money would have been tripled there, right? Or if you even think about it like this, if you have children, this timeline is going to keep going and it's going to keep going, So one day your children are going to be like, damn, Dad, damn, Mom, how come you didn't invest in Apple or whatever, Tesla, whatever the case is, back in 2020 when I was born, because now it's 2040 and we would have been rich. You always hear people say, oh, you would have invested $500 in this company, or if you would have put $1,000 in Bitcoin X amount of years ago, this is how much it would be worth. But we have that opportunity every single day. The market's open, 5 days a week. We choose to ignore it. So that's kind of like why you want to invest in stock markets, is why you want to tie your capital up so your money can make money, right? So you go to work to make money, and then you want to take some of that money and expose it to the risk and expose it to the market so your money can grow. All right. So let's get back to it. All right. So when you Google a stock, you see things like this, right? So this is Beyond Meat, right? So you'll see a pointer. You'll see over here, this is the current price. This is what it closed on Friday. So the market's only open Monday through Friday. It's where it closed. After hours, it's starting to go up a little bit. This is a 6-month chart. You can click on a 1-month chart. You can see how it's been in the last 5 days, the last 1 day, year to date, the last 1 year, the last 5 years, the entire lifespan of the company, right? So this is the chart timeline. And then down here, it'll give you some numbers or some facts about the company. So like this is the open price. So when the stock opened, the last open, this is what it opened at. This is what it closed at. This is the lowest it's been for the day. Down here, you have the market cap, which is the total amount of shares times the price of the stock. You have the dividend yield. If they pay a dividend, it'll show up here. The previous close, the 52-week high. So in the last 52 weeks or 1 year, this is the highest it's ever been. In the last 52 weeks, this is the lowest it's ever been. So if we were to go 1 year back, we can see that somebody possibly could have bought it for $45 and sold it for $239. And if they would have had 100 shares or 1,000 shares, then that's how much they made, right? Like that's how much they made per share, right? So here's a breakdown of what all this stuff means. So because you bought this course, you're going to get a list of resources that's going to talk to you about reading a company's financials. It's going to give you resources on what they mean or what you should be looking for. I'm not going to talk about that stuff too much. We're more going to look at charts, and we're going to talk about strategies and dividend paying investments and stuff like that. So when it comes down to breaking the financials, this will be in a PDF that comes with this course. All right, so moving on. All right, so if you look at different chart timelines, this is what it looks like. So this is what a day chart looks like. This is what a 5-day chart looks like. And this is straight off of Google. So every brokerage account that you have, will provide the same things. You can always change the chart and see. So this is what 6 months looks like. And this is what the last 1 year looks like. So what I want you to focus on is the low points and the high points. So if this is a day chart, so if it opens here and then it falls down here, and then eventually it goes back up here and then it falls and closes, like look how low it went, look how high it went. Same thing on the 5-day scale, on the 5-day chart, look how low it went, look how high it went. So when you're swing trading, you're just basically trying to catch a low point and sell at a high point. It doesn't have to be the lowest point and it doesn't have to be the highest point, right? If it swings upward at all, you have a profit. You need it to swing 1 penny and you have a profit, right? The more money you have invested and the more it swings, obviously, the more money you make. And then the opposite works as well. The more money you have invested and the more it swings the opposite way, the more money you'll lose. But there's strategies to prevent you from taking huge losses. All right, so 6 months. So if you look at this 6 month scale down here, so in February, it was trading up around 120. And then you're going to see this with every single company that we look at, or every single chart. This is when the coronavirus hit. This is when, not when it hit, but this is when all the companies announced that we're closing and that, you know, this thing is a lot more scary than we think. So all the companies fell. You've seen it on the news. You've seen it on social media. You've seen it everywhere. Stock market is crashing, blah, 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 right? This is in March. So you're going to see this with every single company that you look at. But here's the good thing, or here's the opportunity. You always hear people say that you can make money during the stock market crash, or this is when people get rich. It's because look at this. The person that bought it down here less than $50 and then they sold it at 115, like they damn near doubled their money. So while half of the country was screaming that, you know, the world is coming to an end, there were people buying down here and selling up here, or buying here and selling here, or even buying here and selling here. And we're going to talk about those strategies on how you know when to buy and how you know when to sell it. So you can't exactly time the exact bottom. I'm not telling you that I can teach you to buy it at this exact moment, because you don't know how far it's going to fall, right? But if you see it moving upward like here, then you know, okay, I can buy in and I can sell later on, or maybe even here. If it's moving upward and you catch it at this spot and then you sell it at this spot, as long as it moves upward, you're going to make a profit, right? So from the 1 year's chart, it was down here and then the peak way up here. And then eventually it fell down here. So one day it may return there, right? So the price moves, the price fluctuates every day, all day, not all day, but yeah, all day, every day, the price fluctuates. And we're going to talk about that. We're going to talk about why the price is fluctuating. Okay, so where can you buy stocks? Stocks are sold on large exchanges. The most popular one is the New York New York Stock Exchange. And these brokerages have access to the New York Stock Exchange, so you can buy and sell through these companies. TD Ameritrade, I use them. E-Trade, I use them. Robinhood, I kind of use them. I more use them to watch now. Fidelity, Charles Schwab, Webull, there's so many of them out there. So the cool part is, back in the day, like when I say back in the day, I mean like 2 years ago, or man, maybe even last year, most of these companies would charge you money per trade. So if you want to buy one stock, if you want to buy one share in Apple, and Apple costs $200, Fidelity might have charged you $4 to buy one. And then when you go to sell it, they would charge you another $4 or $5 or $6. That means at minimum, you shouldn't be buying and selling Apple unless you make $8 minimum, because you got to cover the brokerage fee. But now Robinhood came, opened up the gates with free trading, commission-free trading, and now all these other companies follow suit. So trade for free now. You're not getting charged a commission fee. All right, so why do stock prices move? So we've seen on the chart how a stock can go from $42 to $240, or, you know, from $240 back down to $52. So the stocks move up and down, up and down. Why? Why do they move up and down? This is kind of like the most confusing part, but it's really, really, really simple. So stock market is like a giant auction. So imagine if you're sitting in a room and 10 people want to buy a phone, but only 7 people have a phone to sell, right? Those 7 people can start increasing the price of the phone, right? So the cost of the phone will go up because the demand for the phone is greater than the supplies of the phone, right? And then the opposite will work as well. If 10 people are sitting around and they have a phone and only 7 people want to buy, then which of those 10 people are going to be able to sell it? Whoever drops their price. So when there's more buyers than sellers, there's a reaction in the market. And when there's more sellers than buyers, there's a market reaction. There's a reaction in the market. There's a reason why people want to buy and sell, but the fact that millions of people are buying and selling is the reason why the stock prices go up and go down, go up and go down, right? So if everybody just all of a sudden, everybody in the world just all of a sudden wants to move to your neighborhood, you can increase the price. You can increase the price of your house. You can increase the price of your house. You can increase the price of your house until people are no longer going to be interested. But until that last person is saying, okay, this is the maximum price I'm willing to pay. So supply and demand, that's the reason why the stock market goes up, right? So millions of people are trading millions of shares every single day. So this is why the market fluctuates all day long. Okay, so what makes the stock price move? Part 2, the reason why investors want to buy and sell their stocks, it varies. Bad earnings. So a company can come out and say, yeah, we're expecting to make $250 million this quarter. And then when their earnings actually come out and they publicize what they made, they only made $210 million. So all their investors are like, you guys suck, we're out of here, you know? So it could be bad earnings. It could be good earnings. It could be news about the company. Maybe this company is being investigated for fraud, or maybe the CEO just stepped down, or maybe the CEO even just sold off all his shares. So now the investors are going to react to this news. The news that comes on the TV, that helps swing people's opinion. So for instance, Warren Buffett just sold off all his stock in airline companies. So that's going to affect investors. Investors are going to say, well, man, if Warren Buffett doesn't want to invest in these airline companies, maybe I shouldn't either. He knows something I don't know. So then they're going to start dumping their shares. So then the cost of the price of the airline is going to start going down, right? So it could be news. It could be something as simple as investors need to liquidate their money. They need to get out of the market so they can, I don't know, go buy something else. Maybe somebody wants to buy a house or something. Whatever reason, people have a reason to buy and have a reason to sell. The fear in the economy, like the coronavirus, or the excitement about the economy, like reopening. So when all these states say, hey, we're going to reopen, then the investors get excited because now people can go out and spend money. So investors are like, yeah, let's start buying up these places and that the consumers are likely to spend their money. So fear and excitement about the economy, even a war can, cause the stock market to take a dip. But most of it boils down to greed and fear. They either get scared because they think that the stock market is going down, or they get greedy because the stock market is going up and they think it's going to keep going up. So people are buying and selling all day, every day. So that's what causes these prices to move. All right. So if you go on a company's website like this, I went to apple.com, and then you can scroll all the way down to the bottom and you go to investors, and then you can see all the public information that they are required to publicize, and also the ones that they're not required to publicize, but they choose to. So you just click on investors and you can get some info there, right? So you can see their 10Qs, you can see their 10Ks, right? You can click on this PDF and you can go through their financial statements. Like I said, I'm going to provide resources for you to read these and be able to make judgments based on what you read. Okay, so this just breaks down the 10Qs are, the 10Ks, what you're going to be looking for when you look into it, how much revenue they make, net income, their earnings per share, their price to earning ratio, etc. Then there's going to be resources for you. Okay, so on earningswhisperer.com, this is a website, and you can click on almost every day. There's a company that's going to announce their earnings, whether they're going to do it before the market opens or after the market closes. But these earnings affect the calls or the prices as well, because like I said, the company might came out and say that they've made way less money than they expected, and the price might drop, or they might say that they make way more money than they expected, and the price goes up. Or they can just show some signs of like progression. So they can say, yeah, we think we're going to lose $2 per share, and they only lose $1.50 per share. So now investors are going to hop in, even though they just lost money. But the investors are like, man, that means you're doing better than what you expected. So cool. So anyways, on Earnings Whisperer, you can go and you can click on the calendar day, and you can see all the companies that are going to report their earnings. And then also, it kind of tells you, it gives you like a very educated, calculated guess on what they expect, what these experts expect these companies to report. So they might say that they expect to beat their earnings, whatever the case is. All right, that's earningswhisperer.com. Okay, so the stock price moves, and it moves only in 3 directions. So it's going up, it's going down, or it's going sideways. That's it, right? It's going up, it's going down, and it's going sideways. So when you look at a chart, and if you've never seen a stock chart before, which I'm sure we've all had, you're going to see that the prices are going up, down, sideways. Okay. Okay, so here's more on the stock movement. So there's a very, 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 very good book that is also going to be in your goodie bag called The Secrets for Profiting in a Bull and Bear Market by Stan Weinstein. And what he did was, this guy in 1987, he predicted the stock market crash. He came up with all these techniques on how he knew it was going to crash, how he knows which companies are going up just based on reading the charts. So this is a very, very good book. It's not that difficult to read. And this is what people use when they're looking at charts. And this is what some people use when they're looking at charts and they're making educated guesses on what they think the price or the price of the stock is going to do, whether they think it's going up or they think it's going to go down or whatever the next move is. Because if you think it's going up based on whatever indicators that you use, then you buy some. And if you think it's going down and you already own some, then you need to sell some or short it, So this is the Sage. Also, there's a very, very, very cool dude named Gerald Peters who teaches this as well. You can find him at thepetersreport.com. He teaches the same thing. So what Stan did was Stan was using 30-week moving averages, and he was looking at a weekly chart. And Gerald moved it to a daily chart, and he added his little bells and whistles in there. But yeah, this is the method that I use as well. Right. So there's technical indicators. So the ones that are used are the 5-day exponential moving average, the 10-day exponential moving average, the 20-day simple moving average, the relative strength index, which is called the RSI, and it's set to 14 days, support and resistance zones, and the MACD. Right. So I'm going to tell you the difference between exponential moving averages and simple moving averages. So a simple moving average is simply X amount of days, the average price of the stock added up and divided, right? So if you have a 20-day simple moving average, in all 20 days, the price of the stock, you add up the price of the stock every single day, then you divide it by the number of days, which is 20, then that's what your moving average is going to be. So the exponential moving average, it puts more weight, or it gives more weight to the more recent days. So if you have a 10-day exponential moving average, yesterday and the day before yesterday have more weight than 10 days ago, right? So that's the difference. Okay, and then we'll talk about the RSI and these other things. Okay, so let me explain to you how you look at this. So this is the price of the stock, right? It's moving sideways. Remember, it can go up, sideways, or down. So it's moving sideways, it's moving sideways. Nobody knows how long it's going to move sideways. Nobody knows when it's going to go up or go down after it starts moving sideways, but you can make educated guesses based on indicators. Okay, so eventually if a stock price is moving sideways and then it starts to go up, if it develops enough momentum, it's going to move past its moving average that you set, right? So think about it like this. If a car is to go from 0 to 100 miles an hour, they have to go past 5 miles an hour to get to 100. They have to go past 10 miles an hour to get to 100. So if you're going to make a guess how fast this car can get from 0 to 100, maybe you should wait until it gets 20 miles an hour, or maybe you should wait until it crosses 5 miles an hour, right? So when it starts moving upwards, this is the time to buy in this zone here. And then eventually it's going to stop moving up and it's going to start moving sideways again. Then when it's done moving sideways, it can go down. It can keep going back up, which is also stage one. So stage one, accumulation and move sideways. Stage two is an uptrend. Stage three, right, starts moving sideways again. It could go another stage one. But in this illustration, it starts moving down, a downtrend. When is it going to slow down? Now, the same thing that I just explained to you about a car, it works when the car starts to slow down as well. So if a car is at 100 miles an hour and it starts slowing down, eventually it's going to get to 80 miles an hour. It has to pass 80 miles an hour to get to zero, right? A car has to pass 20 miles an hour from 0 to get to 100. So once it slows down enough, this is your optimal time to sell your stock. So you buy it here, you sell it here, and that's the name of the game. And then it will keep falling, and eventually it will stop falling, and it'll start trading sideways again, right? So this book, The Secrets for Profiting in a Bull and Bear Market, will be in your goodie bag. And then you can find Gerald Peters at thepetersreport.com. He teaches the same thing that Stan taught. Let's keep it moving. Okay, so you can go to stockcharts.com, and this is where you're going to insert the symbol for the company, and then you're going to be able to put those indicators, and then you're going to be able to read the chart. Okay, so I'm going to break down the chart. This is Beyond Meat on stockcharts.com. So you go to stockcharts.com, then you put the symbol BYND, right? So Beyond Meat, here's the RSI up here. It shows in this area that's in a square. This is where the RSI is, and then this is the actual chart over here. So you have the volume, you have how much, you have how many shares are being bought and sold every day. You have the price of the stock and the date. So November of 2019, the price of the stock was here. November 11th of 2019, November 18th, so on and so forth. Christmas Day, it was here, right? This is basic stuff. So the price is moving because people are buying and selling. Remember that. The price is moving because people are buying and selling. And then the price goes up because there's a demand for the stock. And then it starts moving sideways again. And then it starts falling. And it starts going up and then down. So price can only move in 3 directions, sideways, up, or down. Okay? So your moving averages are going to be over here to the left, right? So this blue line is the 20-day moving average. So in the last 20 days of trading, this stock has traded for an average price of $81.67. In the last 200 days of trading, this stock is traded at an average price of $112. So you can see it here. It's lit up in red, and it's also a red chart. Same thing here, the blue, and then the blue line, okay? All right, so, for the RSI. So when the RSI gets too low, so what the RSI is doing is it's letting you know if a stock is being oversold or overbought. So if it's being oversold, that's probably a good indicator for you to buy it. And if it's being overbought, that's probably an indicator for you to sell it. It's too hot. So the way I look at it is it's either too hot or it's too cold or it's just fine in the middle, right? So if this indicator goes below 30, it's set to 14. So when you go on stockcharts.com, make sure your RSI is set to 14, okay? If this, if their RSI is below 30, this stock is too cold. It's being oversold. Too many people are selling it. So this could be an indicator for you to buy the stock, right? Okay, and then if it goes above 70, that means it's too hot. Too many people are buying the stock. It's likely to go down. And then again, it's too hot here. It's likely to go down. Again, here, it's likely to go up because it's being oversold. And then here again, it's being overbought. So just looking at the RSI, you can see how the RSI is pretty accurate with this stock and the trend. So you buy it here. So imagine that you don't follow anything else. You just simply buy it when the RSI tells you to buy it, right? So the RSI says that this stock is oversold, so you buy it here. And then what's going to happen is, what do you know? It goes up. And then you sell it because the RSI said, yo, bro, this is too hot. So you're going to sell it. And then what's going to happen? Eventually it dipped, right? So the RSI was correct. It took a dip in price, but then it, it starts moving a little sideways, up a little bit, but a little sideways. And then it tanks. So just think about this. If you buy it here because this RSI was telling you that it was oversold and it's too cold, this is a good time for you to move in, and you sell it here, right? You would have avoided all this. So you would have avoided the stock price falling from $130 down to less than $50 per share, right? So the RSI isn't just the only indicator that you're going to use, but I'm showing you how it could save you, in times when it's screaming like, yo, bro, get rid of this stock or buy this stock. Okay, so imagine you just simply listened, right? If you would have listened, you would have avoided this headache of this stock falling. And then when the stock is here, all right, so let me tell you something. When the stock is falling, nobody knows how far it's going to fall. But eventually, it's going to stop falling. You just don't know when. And I'll explain why it's going to stop falling. So I know this is just a chart and people are looking at it and saying like, okay, it failed and it came back up. It's not as simple as it fell and it came back up. It's people's money is involved, right? So imagine if you have $30,000 invested and then the value of your company, of your investment just fell by a third, or even fell in half. You're gonna freak out. So you're gonna freak out and you're like, man, I need to sell it. I need to sell it because the sky is falling. Excuse me. So it's a lot deeper than the price is falling. It just seems like that when you're looking at a chart, but remember people's emotions are involved because their money is involved. So everyone's selling because it's falling and it's falling and it's falling. Then there's going to become somebody here or maybe even a group of people here that are saying, hey, I know everybody is selling, but this company, the stock is worth something, right? So I'll tell you why. So what Gerald Peters says is that there's a buyer for any asset at the right price. And I love that. So check this out. Imagine if your house is worth $1 million and then you're like, hey, I want to sell my house. You want to buy it for 900,000? And everyone's like, no. And then you have to go down in price, 800K. Everyone's like, no. 700K, no. So this is the value of your house. It's just falling. It's at a free fall, right? 600K, everyone's like, no. 500K, no. 400K, no. Eventually, somebody is going to say, I'll take your house because the price is going to be too low. It's still an asset. It's still a house, right? It's still a house. It doesn't change the fact that it's a house just because, somebody wants to live there or somebody wants to use it to rent it out. It's an asset, right? The same thing with a phone. The price of your phone can just keep falling. If I ask you if you want to buy my phone if I ask you if you want to buy this phone for $10,000, you would say no. And then I would just keep going and keep going and keep going. Eventually, I'm going to get to the point where somebody says, I'll buy your phone. So eventually the price is going to stop falling, right? Because if I said, do you want to buy this phone for $30, you're going to say yes, because you can sell the phone for more one day, right? So that's why. So eventually people are going to start buying. People will stop it. The investors will stop it from falling because it's going to be a great price, a great asset, or a good asset, but at a great price, right? So eventually it stops falling. This is why companies don't go to zero. Some companies do go to zero. There's usually fraud involved, or the company just flat out sucks. But it happens, and that's the risk that you have to be willing to take. Okay, so the company stops falling on this day and it slowly starts to make a rebound, but you buy it. Let's say you're just following this RSI blindly. So you buy it here, and then eventually you just hold it until the next RSI reaches the extreme. So it goes up, it comes down, and then on this day, it's too hot. So you bought it for $50, and now when it's over here at 112, it's too hot, so you sell it. So just following this, you would have doubled your money. But I'm here to tell you that the RSI simply isn't enough, but it's a good indicator. It's a good indicator to add or equip with something else, right? But it's not enough for you just to gauge it alone, because sometimes it'll say that this stock is too cold and then it'll keep falling, or it'll say the stock is too hot and it'll keep rising, right? So this is why Stan uses the moving averages, right? So what Stan said was that if a stock was to cross the 30-week moving average, but we convert it to the 20-day moving average, that is the optimal time to buy. So remember this. Backwards. Okay, so remember, this is the optimal time to buy. This is the optimal time to buy when it crosses the 30-week moving average or when it crosses the 20-day moving average, right? Because we're looking at a daily chart. So remember, this left pocket is the time to buy. So when you're looking at Beyond Meat, look at exactly what happens, right? It crosses above, it starts trading above the 20-day moving average at this exact point. So you buy it, and then look what happens. It shoots up, right? And then eventually it comes down a little bit, goes back up, and it comes back down. Now it's trading sideways. It's almost even. It's almost trading exactly with the 20-day moving average. So on this day, it falls below the moving average, then it comes right back up, and it falls below, then comes back up. But right here starts trading below the 20-day moving average consistently. So we're gonna go look and see what that means. Once it starts moving in the downtrend, you have to get rid of it, right? That's your time to walk away. So you bought it here, and you're gonna sell it here. You bought it when it crossed the 20-day moving average, and then you're gonna sell it when it trades consistently below the 20-day moving average. And then you're not going to do anything. So you take the profit. You bought it down here at 75. You sold it on this day over here at 112. That's pretty good. That's a good swing. So when it falls, it's just going to keep falling, like the price of the house that I just used. Nobody in the neighborhood wants to buy this house. And you're not going to even pay attention to the house until somebody else stops it from falling, right? So it falls and then it comes back up, right? But just because this price starts to move back up, it doesn't mean that you're going to buy. Remember, your indicator to buy is when it crosses the 20-day moving average. So if this blue line is the 20-day moving average, when does it cross the 20-day moving average again? Here. So it crosses the 20-day moving average again, so you buy it, and then look what happens. It moves up. So this went pretty well hand in hand with the RSI. So the RSI said buy here, but instead you buy here. RSI said sell here, but you sold there, right? And then it fell, and when it falls, you're not Captain Save a Stock, okay? So when it falls, you just let it fall, and you let it fall, and you let it fall, and people are screaming the world's going to end, but you don't care because you took your profits, and then eventually it crosses the 20-day moving average, and then you repeat the cycle. So you'll buy it here, and you'll sell it here. So another good thing, another key thing for you to know is the 200-day moving average. The 200-day moving average is about it's the price that the stock usually trades at, right? So when you look at enough charts, you'll see that if the price gets too far below the moving average for 200 days, it'll come back. If the price goes too far above the 200-day moving average, it will come back, right? They're averages for a reason. So if I told you that Steph Curry shoots 50% from the three-pointer and then he misses 3 shots in a row or 4 shots in a row, he shoots 50% from the three-pointer, the probability of his next shot is that it will go in, right? Even if he misses it again. And actually, because of his averages, the more he continues to miss, the more likely it is for him to make the next shot. So that's just the law of averages, right? So if you buy it here, so you jump in Beyond Meat at $70, at $69, $68, and then you sell it here because the RSI told you, bro, this is too hot. And look, it tags this 200-day moving average, so you know, like, okay, it got to where it was or where it usually trades at, so I'm going to walk away. Or I'm going to sell some of my shares and then keep the rest and see what happens, because it could have this pullback here and then keep going upwards, right? But you don't have to sell your whole, position until this closes below the 20-day moving average. So it's far from that. So this is why you can be in the market. You got in here, the market has 3 or 4 consistent red days, which means that the prices are falling, but you're not tripping. You got in down here and you're chilling here. So as long as this price doesn't close below the 20, it didn't start a new downtrend, okay? moving forward. Okay, so when you go to stockcharts.com, you're going to have to put the 20-day moving average and the 200-day moving average in. It's going to be at the bottom of this chart, and this is what it looks like. Simple moving average, 20 days, simple moving average, 200 days. Then you can keep going. You can go exponential moving averages if you want. Gerald teaches that. You guys can go check out his trading strategy. But for this simplicity of this chart, I'm just going to use the 20 and the 200. Okay. Okay, so this is just reiterating what I already said, which is this is your time to buy, and this is your time to sell. All right. So look how Beyond Meat plays out perfectly, right? So stage one, it's moving sideways. Stage two, look how Beyond Meat is almost exactly like this. All right, so stage two, your optimal time to buy, here it is here. Then it runs up, it starts moving sideways, and then stage four, downtrend, and you're gonna sell here, okay? And then you're gonna repeat it again, buy here, and then you're gonna sell it up here because RSI told you, bro, the stock is too hot. All right, if you're a robot and you just follow this, you're gonna have more successful trades than you won't. It's when people get greedy or when people get afraid and they move away from their strategy. Okay, so here goes another one, Tesla. Tesla crosses the 20-day moving average. You buy it, it runs up from under $350, and then it runs all the way up. It gets up to 9 something, and then eventually it falls, right? So I bought in Tesla last year, about 303 shares at $234 last summer, and then I sold some, and I'm still holding on. But how did I know to buy? It was the RSI was, if you can go backwards, the RSI was screaming, this is being undersold, and I just held it, right? But this was a great time to buy. And it crosses the 20, and then what happens? It runs up. So if you have, and then you sell some here, and then eventually it starts falling, and then you're not worried about it. You're not Captain Save a stock, all right? So when stocks start falling, it's not your business. You got rid of yours, right? It crossed the 20, so you sold yours. Not your business anymore. So then what happens is it crosses the 20. So here you come. You're a hero. You buy it after the 20, and then it runs up. So you see how it ran up, and then it start pulling back. So the current price is here in black. The current price of Tesla, well, when I'm making this video, is $701. The 20-day moving average is 685. So it started pulling back, but it still stayed above. The 20-day moving average. If it was to close below the 20-day moving average, you get rid of it because you're not Captain Save a stock, and it might keep falling all the way to the ground, right? It might just keep falling and keep falling. Another thing is, here's the 200-day moving average. So when the stock ran away from the 200-day moving average, eventually it pulled back. The stock runs away from the 200-day moving average, eventually it pulled back. It might keep pulling back here, or it might go again. But just know, one, you're trading above the 200, and two, it's about to close, or it's very near the 20. So I say all this to say that. To say this, somebody might ask you, should you buy Tesla? Should you buy, I don't know, it could be anything. It could be the hottest stock. Should you buy a Smile Direct Club or Roku or whatever, right? Whatever everybody in the world is talking about. When you log onto Facebook, everyone's talking about Tesla or talking about Roku or Beyond Meat or whatever. And you're thinking, should I buy it? Should I buy it? Should I buy it? But this is when people start talking about it, when it's here. So it's not really even about what you buy, minus if their fundamentals look good, their numbers look good, right? But it's not really about what you buy. It's about when you buy it. So if you buy Tesla down here and it's here now and everybody's talking about it, and I buy Tesla right here because everybody's talking about it, and Tesla's currently right here, you bought Tesla and you have an amazing return. I bought Tesla and I'm down money. So this is why a lot of people who are new to the stock market will say, what should I buy? What should I buy? It's a lot of it when you're, especially when you're trading, it's more about when you should buy and not what you buy, right? So we'll look over here at Facebook. About Tesla. You see how the RSI was low on Tesla? The RSI was high up here on Tesla, but then it kept going up. But eventually it fell. And then the RSI got low. Look how the RSI reaches this low point and then it climbs back up, right? Okay, so Facebook. Let's say you own Facebook and it dips below the 20, so you get rid of it. So in theory, you could get rid of it this day because it was below the 20-day moving average. But then it crosses above the 20-day moving average, so then you would have bought it again. And you're just going to hold it until it starts trading consistently below the 20, which is on this day. So you get rid of it. You bought Facebook in at 205 and you got rid of Facebook at 215 because the RSI was hot and then it started falling below the 20. So on this day, it starts trading consistently below the 20. What happens when it trades consistently below the 20? It dips, starts to come back up. So you're like, oh, okay, I'm getting back in on Facebook. You buy it. So I want you to look at the dates too. So this is January 27th that you sold it, and then you buy it again on this day because it crosses the 20, which is February 18th. So this took 2-3 weeks to play out. And then you buy it, and 2-3 days later, you have to sell it again because it fell below the 20, right? So when it falls below the 20 this time, it's not playing, it's really falling. And just remember, you're not Captain Save a stock. So when it starts falling, it's not your business. Just let it fall, right? And then when it comes back up and starts trading above the 20 consistently, boom, it crosses the 20. The next day, it stays above the 20, and then it runs, right? It tags the 200-day moving average here. So you buy in, let's say you buy in this 165, and now it's at 191, right? Or you could have sold it up here because the RSI didn't get extreme, but it got pretty hot. But you just buying here and selling here, that's your move. Buy here, sell here. Buy here, sell here. Buy here, sell here, right? So that's the name of the game. So look how simple this is when you're just looking at a 20 and a 200, right? A 20 and a 200. So remember what I said about the average. Facebook's trading above the 200-day moving average, which is this red line. Facebook is trading above it. What happens? It comes back to meet reality, and then it starts trading below, and it's going to come right back to meet its average. All right. So, you know, when I post, like you guys see me post on my Instagram and post on my Twitter, like, oh, this company's doing well. And then everyone thinks like, bro, how did you know to buy it? And this is how I knew to buy it because, you know, it crossed the 20, man. And then this is how I know to get rid of it because it fell below the 20. But you can't just pick any random stock and follow this. You have to make sure that this company has some way of making oh, whew. All right, so let's move on. All right, so this is when sometimes I like to gamble, right? And when I'm gambling, it's calculated, right? It's not just a random throw a dart at the chart gamble. I'm gonna tell you when I gamble and I'm gonna tell you why I gamble, right? But if I buy a stock before it crosses the 20-day moving average, I call that a gamble, right? It doesn't matter if it's the best company in the world. It doesn't matter if it's Google. It doesn't matter Amazon. It doesn't matter anything. If I buy it below the 20-day moving average, in my eyes, I'm gambling, right? But there's a time to gamble, and I'll show you. So GoGo, what they do is they provide Wi-Fi. They provide Wi-Fi in flights, okay? So, all right, everybody sells GoGo here. Why did everybody sell GoGo here? Why did you sell GoGo here? Because it fell below the 20. Great job. So you're not Captain Save a stock, so it falls away down there. You buy it here, but then you have to sell it again because it fell below the 20, right? And now it's moving this way. It's going down. It comes up. It goes down. So notice on this day, May 16th, this is when it stopped falling, right? So this is when whoever was Captain Save a stock saved it right here, right? So this is when the sum of investors all decided collectively with their buying power that this is when we're going to save this stock, right? So Gerald likes to say price has memory, right? So I like that. Price has memory. So if this is the lowest that it's been, right, you just, if this is the support, so you're just going to take note of that, right? So it's going down, boom, it tags it down here again, then it pops right back up, and then it tags it right there, and then it's coming back up. Okay, so the current price for this stock is $1.57. The 20-day moving average is $1.74. So remember, the strategy is to buy when it crosses the 20-day moving average. But I'm going to gamble on this stock, right? So I'm going to gamble on this stock, and I'm going to buy it now at 157. And the reason I buy it at 157 is because it doesn't look like it can go too much lower, because we've seen on the worst day over here, it only went, like, it didn't fall any much further than $1.57, you know? So this is the floor. This is the support line. So I'm going to gamble here. I'm not going to gamble on this day. I'm not going to gamble on April 13th because, one, the reason I'm not buying on April 13th is because the price is below the 20, but it still has room to go down. I can just look left and see how far it's fell before, right? So I look to the left and I say, oh, look, it used to be down here. So if it used to be down there, it could possibly go right back there. So I'm not going to gamble here, right? So when I am going to gamble, I'm going to keep my position small, and I'm going to gamble when the stock is sitting on the floor. So at this point, the stock is sitting on the floor. If you gamble on this day trying to jump it and saying that it's going to go above the 20 right here or here, you ultimately will pay the price, right? But if you gamble here, the stock isn't likely to go much lower. It still can. You can set a stop and prevent it from falling any lower than what it actually is. But if you were to gamble, this is when you're going to gamble. And the reason why you do gamble is because you can get a head start for the target. So the target is the 200-day moving average, which is $4.63. And you're going to buy it now, 157, even if it hits here, which is a peak, a spike, which is 350, right? Like a previous high. So if you were to buy at 157 and buy it and sell it at 350, look at your return, right? Your return is amazing because you jumped the gun. And if you choose to jump the gun, then keep your position small, right? Okay, Hertz, same thing with Hertz. Hertz falls below the 20. You knew to sell it right here because the RSI was hot, but then it fell below the 20. So now you know for sure to sell it. And then it starts falling. It starts falling. It starts falling. You're not Captain Save a stock, so it's not your business. Then it goes up. You buy it because it crosses the 20. You sell it because it falls below the 20. You buy it because it crosses the 20. You sell it because it falls below 20. You don't have to buy it just because it crosses the 20. You can wait for it to trade a few days or start the actual uptrend. So you don't have to buy it here and sell it here. Okay, so on this day, it looks like it's going to cross the 20, and then it doesn't, right? It falls right back below the 20, but then it's near the support line over here, right? So if you were to draw here, this would be your line of support, and it's near the floor. So this is where I'm going to gamble. And if I gamble, I can get a head start on the 200-day, or sorry, on the 20-day moving average. Give me 1 second. I have to ask my brothers to bring the lab chart charger down here because my phone's going to die and I don't want this to not get saved. All right, so let's move on. Actually, let me not take chances. All right, I'm going to go grab this charger. Give me 1 second. All right. Okay, so if I'm going to gamble with Hertz, this is when I'm going to gamble, and this is why I'm going to gamble here. I'm not going to gamble here because it can still go back down to the previous low. Moving on, pets. Okay, so I'm going to show you exactly what I mean. So looking at pets, pets is hot right now, right? So everyone's talking about pets. Someone tells you about pets, you're going to say, I'm not buying because the RSI is extreme. It's already ran its course. So I don't know. It might keep running, but you're not going to have the fear of missing out and buy it. You're going to buy it here, and then you're going to, you can let it run, or you can sell some here. Anyways, let's go back in time a little bit with Hertz. So Hertz it crossed the 20 here. This is your best time to buy Hertz. So to buy Hertz at $27, and now it's currently at 38. Cool, this was your best time. Now I'm gonna tell you your best time to actually gamble. Your best time to gamble was down here because it tapped the floor of its previous low. So it was down low here, so you're gonna wait until it gets down low here, right? If you were to gamble here, it would dip. Eventually it would have came back up, but you would have took this loss, right? Or you would have lost some money, and then eventually you would have made some, or the value of your account would have went down and it would have came back up, right? But this is the worst time to gamble because it's above the previous low.